Assalamualaikum and hi everyone. Welcome to my channel. I am Yusna Liza Hamid. Today we are going to have a presentation for MFRS 10. This is the first part of the presentation. MFRS 10 is dealing with consolidated financial statement, and in terms of the compliance and comparison with IFRS 10, it is equivalent to IFRS 10, and that is issued by the IASB. And when you comply with IFRS 10, you are also complying with MFRS 10 and vice versa. Right. Let's look at what do we have here. Before this, in my video, my previous video, you can check down my channel, where we discuss on MFRS 3 in 3 separate videos, and where we don't define the term control at that point, because the term control is not defined there. It is defined in this MFRS 10. Notice we do not describe as well the consolidation procedures, right? So far there were no consolidation being done. MFRS 10 is the one that prescribed the single control-based model, and that control-based model will be used by the acquirer to assess control, to assess whether they have control in the investee company or the acquiree. And this MFRS also determines the scope of consolidation. And the MFRS 10 is actually MFRS that are directly related to MFRS 3 that was applicable in MFRS 10 for the annual reporting period. So it was there since 1st of January 2013. The objective of MFRS 10 is to establish principles for the presentation and preparation of consolidated financial statements. So MFRS 10 needs an acquirer to prepare a consolidated financial statement if the acquirer obtains control in the acquiree. To meet this objective, MFRS 10 actually requires the entity that is apparent, as I mentioned, the acquiree, and in the terminology of the MFRS 10, the acquiree will later be a parent, and the parent that control one or more entities, which is the acquiree that is being controlled will be termed as subsidiaries. We'll see that later. Therefore, the parent will need to present the consolidated financial statement. This MFRS also defines the principle of control, establishes control for the basis of consolidation. So meaning that if there is no control, there is no consolidation. Only if you acquire control, then there is a need for consolidation of financial statement. This MFRS also said how do we apply the principle of control, and how do we identify whether the investor actually gain control of an investee. Because when you gain control, you must consolidate the investee. So it's not an option, it's a requirement. So it also sets out the accounting requirement for the preparation of consolidated financial statement, defines investment entity, and set out the exception to consolidating this particular investment entity. Yep, right. So if you look at the diagram here, as I mentioned, the most important thing is to assess whether there is a control. So this is showing the level of investment with an investee company by the investor. Investor also known as acquirer. Investee also known as acquiree. So what you need to do is, if you were to think whether or not do you need to apply MFRS 10, you need to first assess whether there is a control. If the answer is yes, the acquirer generally will need to consolidate the financial statement. And when you say consolidate, means consolidation of results in terms of the financial result. And IFRS 10 is prescribing the principle for consolidation. However, for the disclosure that will apply, IFRS 12, which is MFRS 12 in Malaysia. Yep. For the rest of the arrangement that you have here, or for the rest of the involvement, this one will not be within the scope of consolidation. You may have joint control, where joint control will just be equity accounted if that is a joint venture, and if you have a significant influence, that will also be equity accounted. So that one will be the case where you have less than 50% of interest acquired in the subsidiary. So you will also come across financial assets. Financial asset is where the investment is less than 20% in another entity. Significant influence will be going and doing that in the later stage, which is at our other videos, the different parts, right? So under control here is that you can only say that you can consolidate, or you must consolidate if there is a control. No control, no consolidation. So the remaining items here, the remaining investment will not be consolidated in terms of the entity. It will be guided by different MFRS, different IFRS, right? Let's look at the next one. What is consolidated financial statement? You are familiar with the term financial statement. So when you talk about consolidated financial statement, it's about a combined financial statement of a group in which the assets, liability, equity, income, expenses, and cash flow of the parent and its subsidiaries. So it's about the parent result plus the result of the subsidiaries. And they are now being presented as a single economic entity. Legally, it is a separate entity, but in terms of accounting point of view, they are one single economic entity. These are the components of consolidated financial statement, and our focus for the presentation is not yet to prepare the financial statement yet. It's just to go through the principle of the consolidation. But if you would like to know, consolidated statement of financial position will be done later when I will upload another video on preparation of consolidated financial statement in several videos. And we also be in our focus here, preparing consolidated statement of profit or loss and other comprehensive income. This is the component. Consolidated statement of changes in equity, consolidated cash flow statement. However, this will not be within my discussion. This, if you are interested, it may have been done in other avenues. But here we are not focusing on consolidated statement of cash flow. And also the notes to accompany the group financial statement. And if you notice, there are important terminology that I mentioned. However, MFRS 10 does not define the term investor and investee, but these terms are being used extensively. In practice, investors refers to the reporting entity or the potential parent. Investee refers to an entity that might be a subsidiary. An investor, therefore, according to MFRS 10, will need to assess whether it control the investee, so as to determine the next stage whether there is a parent subsidiary relationship. So what is parent and subsidiary? Because parent and subsidiary together, they will make a group. They will form a group. A parent is an entity that controls. So parent has the entity that control either one or more entity. So if you control one entity, right? Even if you control one entity, that control will give rise to the requirement of having the accounting consolidated. Next, a parent has been defined. Subsidiary, this definition you can go and check. It is available in Appendix A of MFRS 10. I will put the link to the MFRS 10 down the description. You can download MFRS 10 and have a go on what was prescribed actually. This is just a summary of it. Some summary. Subsidiary is an entity that is controlled by another entity, right? So if you are being controlled by another entity, it is most likely that you are a subsidiary. What is a group? A group is a parent and its subsidiaries. So parent and the subsidiaries together, that will make up a group. There are a lot of group of companies in Malaysia, like the Sime Darby Group, Petronas Group, and there are many more, but those are all Malaysian listed company that have the subsidiaries all over the world, like in the case of Petronas. A parent-subsidiary relationship rests on a very important criteria, which is the key to the relationship is the control. And in law, legally, the parent and subsidiaries still remains a separate entity physically and legally. Only that from an economic point of view or accounting point of view, they can be one single economic entity, right? Entity that is a parent, remember, shall present or must present the consolidated financial statement. Next, what is the need to prepare consolidated financial statement? So subsidiaries, apart from they are subsidiaries, the investee, they have to maintain separate record and they have to prepare the standalone financial statement. So the subsidiary, right, will prepare the financial statement, and this is the standalone financial statement, individual financial statement. The parent, which is required by Companies Act as well as the accounting standards, like here the MFRS 10, to prepare the consolidated financial statement. At the same time, the parent also need to prepare the separate financial statement. So parent has two financial statement that has to be prepared, which is the consolidated financial statement and the separate financial statement. Consolidated financial statement will combine the result of the subsidiaries, but the separate financial statement will show its own financial statement, right? So consolidated financial statement disregard the legal boundaries, right, and of the separate legal entity. But however, they are important because users of the parent financial statement will need to know about the financial position of the parent as a result of the operation, as a result of acquiring another business, and what are the changes of the financial position once the subsidiary or one the investee is becoming part of the group as a whole. So the shareholder of the parent company, by referring to the group financial statement or the consolidated financial statement, sometimes they are called group accounts. They can make effective economic decision because the consolidated financial statement or the group accounts will show the result of the group operation shown as a single commercial economic entity. So these are the principles, some of the principles for consolidation, where the financial statement of the group or the consolidated financial statement must be prepared based on a uniform accounting policy, same reporting period. It also must eliminate if there are any intra-group transaction and balances. We'll be doing that a lot as one of the process to prepare the consolidated financial statements. So if there are transactions between parent and subsidiaries, they are considered as transaction between group members, and therefore it has to be eliminated. Also, we are going to look at non-controlling interest. Again, remember in MFRS 3, that is talking about non-controlling interests in terms of the theory, and the application to the non-controlling interest in the consolidated financial statement is actually in the MFRS 10, right? Also, you should understand that if you are an investment entities, they do not present consolidated financial statement. What is control? Because we say that control is the key criteria, key criteria for the parents. So this is a definition of control as laid down by MFRS 10, paragraph 6. So let's see the definition of control. An investor controls an investee when the investor is exposed. So there is an exposure or has rights. Investor has the right to variable return. So investor, as a result of control, will have the right to share the return from its involvement with the investee. So some of the returns or some of the income of the investee will be now shared by the investor, and it has the ability to affect those returns. It has the ability to actually direct or change the decision, those returns, through its power over investee. So definition of control, as I mentioned earlier, is the key to determine what to consolidate. Investor will decide whether it is apparent by first assessing whether it controls or not the investee. So according to MFRS 10, paragraph 10 to 18, investor controls an investee if and only if the investor has all the following key elements, key criteria. Yeah. So these are the three key criteria. The first one is that it has power, where power here is power over investee, and power is talking about rights. So you're going to see that we're going to focus on rights. That gives the investor the ability to direct. So we're going to look at the ability of the investor using the rights to direct the relevant activities in the investee. So that was under MFRS 10, paragraph 10 to 14. The second important key criteria in the definition of control is exposure. When you are an investor, you will be exposing yourself to the variable returns coming from your involvement with the investee. So that was prescribed in paragraph 15 and 16. So the key point here is about the return. The first one is about the power. So power should be there, and your rights to the return should be there. And the third one is how do you use your power to affect your return, which is the ability of using the power over the investee to affect the amount of investors' return. How have you made difference to the decision made by the investee company so that it would actually bring more return to you as an investor? So there is a link between power and return. So that is in the third part, meaning to say that that is the key element. Whether there is a power, whether that power gives you the right to the returns, and what are the link between the two. Are you able to use the power to maximize your return? So therefore, control, if I can summarize here, equal power. So control is about having power. which you have the power together with giving you the returns, and as a result of how you use the power to actually brings you more variable return. So that is about link between power and return. So now we shall look at the key element that is very important, which is power. So what is actually when we talk about power in the context of MFRS 10? According to MFRS 10, an investor has power when it has existing rights. So it's about rights. Where that rights give the current ability to direct the relevant activity. So power is about an investor that has the rights, and that rights give the ability of the investor to direct the relevant activities in the investee. Activities that are relevant are activities that significantly affect the investee's return, right? So there are three important item in the key element power here, where it's talking about existing right, current ability, and relevant activities. We shall go into that now. So what is rights? Because we were talking about right. Right arises from power arises from rights. So right is about how you influence decision being made by how rights here is how decisions are made by the investor. So the right that you have will influence how decision that you made, assuming you are the investor. These are some example of right that can be looked at it as an individual, or you can combine that rights together. Voting rights. Do you have voting rights in the investee company? Does that rights give you the right to vote? Do you have the rights to appoint or reassign or remove members of the key management? Let's say the board of directors of the investee company. Do you have that right to do so? You have the right to appoint or remove another entity that directs the relevant activities. If you have another some activities that is related to the decision made by the investee, do you as a parent has the right to appoint or remove that another entity? The right to direct the investee to enter into. So if you have existing right, means you have the right to direct the investee company to enter into some kind of contract, some kind of transaction for the benefit of investor, and other rights that may be specified in the management contract that will give the holder the ability to direct the relevant activities. So that is about rights. And even rights can be further divided. First one is voting rights. So when do we have voting rights? So remember when we were doing MFRS 3, I mentioned that according to MFRS 3, if you have power or if you hold half of the voting rights, more than half of the voting rights. So you have a voting right if you as an investor hold more than half of the voting shares. Voting shares here is the issued ordinary shares in the investee. So as the investor, you have the power, you have the voting right in terms of the following situation. The relevant activities might be directed by a vote of majority because you hold that majority voting right. Let's say 75% of the shares are held by you as an investor. So the relevant activities or decision being made will be directed mostly or will be somehow affected by how you made your decision. Majority of the members of the governing body that direct the relevant activities are appointed by a vote of the holder of the majority of the voting right. If you are the one that appoints the majority of members of the governing body, if you do not have board of directors, maybe you have the governing body, but you are the one that appoint those directors. So you are likely to have the majority of voting rights. The most commonly test of control that is used in our level, the level of just an introduction to company account, is this actually, looking at whether do you notice or not the investor company hold more than 50% of the equity interest in the acquiree, either directly and indirectly. Our focus will be on more of direct interest. The indirect interest will not be our focus, because this will be in your more advanced consolidation study, right? So in our case, if you have direct control of more than 50%, 51%, 60%, 100%, you are said to have a voting rights, and that rights give you a control. So these are some of the indicators that could result to a voting right by an investor through contractual agreement, by looking at the size of your voting rights relative to the shareholders' dispersion, right? Potential voting rights, if you may also include potential voting rights, and that's going to be discussed later, must be substantive. If there are any facts and circumstances available proving that you have that voting rights. If also based on the attendance at the AGM, changes of the percentage of the voting rights affected by the attendance of the other shareholder. So let's say most of the shareholder did not attend the meeting. You as the investor are there, so therefore you are said to have the voting rights. And you must also assess other indicators that could result in control by other shareholders, including whether a minority shareholding has control. Let's say you hold a shares of 40%, right? And the remaining investor hold a shares, you hold a shares of, let's say, not even a control 40%, but the remaining hold a shares of 60%. Sometimes you may have a voting rights as well, whether when the minority shareholder has control, right? So we need to go into detail later. Attendance in the AGM as well. So voting rights, size of the investors' voting rights relative to other shareholders' dispersion. So in terms of MFRS 10, paragraph B42A, go to that MFRS and check it out. The more the voting rights the investor hold, the more likely that the investor is to have power. Or we can say that more voting rights is about power, more likely to hold existing right. The more the voting rights an investor hold in comparison to the other shareholders, the more likely it is to have power. If you have more as compared to other minority non-controlling shareholders, if you say, let's say 10 shareholders, they hold 6% of shares each, 6%, and it makes up 60%. You hold 40% of the shares. You may have the power because the remaining shareholder hold a very minimum shareholding, yeah. And if they are proven cannot be team up together to likely hold the power. So more likely that you are the one that hold the existing right. If the greater the number of other parties that would need to act together. So as I said to you just now, if you need more numbers to act together to outvote the investor, so even if 6 are not possible, so let's say you need like more than that, and that is the only way that we can outvote the investor as the parent. So the greater the likelihood that the investor is still in power. So the more likely the investor has the existing right. If there is a difficulty for the other shareholders to act together to outvote the investor. Voting rights, sometimes in certain circumstances, investor has lack of obvious significant rights. So it looks so obvious that it has the significant right is not there. If that is the case, you cannot simply conclude that there is no voting right, no rights, because investor must assess whether it has the practical ability to direct relevant activities. So at your level, we'll not be going into detail, but what you can take note is that basically sometimes even without the contractual right to do so, right? Sometimes you may have the ability to approve the management personnel or the board of directors. If that is the case, you are likely to have the voting right. Investor can also have the voting right through the veto or any changes that are significant for the benefit of the investee. You can also read this if they can dominate the either the nomination process for electing members of the investee's governing body. Investee's key management personnel are related parties of the investor. So this one will be covered in great detail in your advanced study. Majority of the members of investing governing bodies are related parties of the investor. So if this scenario in A, B, C, D, E can be proven, you are still having the voting right, even though you as an investor you have some lack of obvious significant rights. So that is quite tedious to assess. The next one is about substantive right. So to have voting right, investor must also check whether their investees, the right in the investee company is substantive, not protective. What is substantive rights? MFRS 10, paragraph B22 to B25, which is at the appendix section of it, appendix B, it clarifies that for a right to be substantive, the holder must have the practical ability. You should have that practicality, or it should be realistic for you to exercise the right. To determine that, judgment is needed, and when you do judgment, you may need to also take into consideration other facts and circumstances. What are the barriers, economically, financially, or others, that prevent you from doing so? And if there are any exercise of right that require agreement of multiple parties, right? Whether those parties themselves have the practical ability to exercise their right together collectively, right? If the rights are held by more than one party. So you need to check that as well. Whether the party or parties, if there are more than one, hold the rights that would benefit from the exercise of the right. So if they hold the right and they benefit from the exercise of the right. And whether the rights are currently exercisable. So this will lead to some kind of potential voting right. So it should be currently exercisable. So meaning that it is not for you to wait in a 1 year time, 3 years time. If you want to exercise the right, you can do it now. You can delay it, but you can do it now, because that is about the substantive right. Please go through and work through example 1 after you have come to this slide 70, which is at the textbook, work example 1, 2, 3, and 4. Please work through that entire solution given. You need to work through it at your own time. I'm not going to go through with you, right? So you need to do that because it is there in the example section. And now we go to the second element that is under power, the second point in the definition of power, which is the current ability, right? So the previous one here, we have already moved to current ability, yeah, when we start talking about rights. Now we move on to the next one, protective right. Remember, voting right, if that is only substantive, not protective. That was the explanation earlier. So the rights that are protective are rights that relate to fundamental changes to the activities of the entity or the investee. They are designed to protect the interests of their holder, but that rights, if you have protective rights, that has no power given to you over the investee. So if you just have a protective right, that is not about having power. You may just notice that this could be, let's say, the right of a lender, a bank, for example, to seize asset of a borrower. So let's say you are giving loans to your subsidiary company. So that rights as a lender to seize the asset of your, let's say, investee company as a borrower, that one is a protective right, not substantive right. Or rights of the holder of non-controlling interest in the investee. So the non-controlling shareholder also have their voice. And that is why in Malaysia we have the minority shareholder watchdog group to protect the interests of the non-controlling shareholders. So therefore, if the right of the holder of a non-controlling interest here, this is also the protective right, because that one are designed to protect the interest of the non-controlling shareholder, but that does not give them power. Next one is whether or not, when we talk about power just now, right, about rights, exercise right, that give you the current ability. So the current ability is, do you have the majority of voting rights? Voting rights normally arise when investor has the current ability through voting or similar rights to direct the relevant activities or decision making in the investee. Investor that hold more than half, which is dominant majority of the voting rights of an investee, is said to have power in the following situation as laid down by paragraph 35 of Appendix B in MFRS 10. Okay, they are said to have the majority of voting right if the relevant activities in the investee are directed by a vote of the holder of the majority of the voting rights, or the majority of the members of the governing body that direct the relevant activities are actually appointed by the investors' vote of a majority. So that also will give you the majority of voting rights. Therefore, having the majority of voting rights or holding the shares of more than 50% is most likely to give you the majority of the voting rights, and therefore will give you power. Let's look at some illustration example for majority of voting rights. Elman Berhad acquired 40 million shares from 50 million ordinary shares in Biscoff, right? The remaining 10 million, so 40 million out of 50. Remaining 10 million are held by other shareholders, 100 of shareholders. Maybe they do not even know each other. They cannot contact each other. Yeah. And you are asked to explain whether Elman, as the investor, has control over the investee, Biscoff. Okay, what is the answer? For your case here, investor, yes, it has control. Why? Because it holds the majority, which is 40 out of 50 million is actually 80% of the shareholding in Biscoff. So there is a majority of voting in terms of the shares that you have acquired. And that can be, therefore we can conclude that Elman has power over Biscoff. Why? Because it has a dominant or majority voting interest, which is more than 50%. Sometimes you may have majority of voting rights, but you have no power. Yeah. So you thought that you have power, but somehow that is not a power, and therefore you cannot control. Therefore, this even if you hold majority of voting right, if those rights are not substantive, according to paragraph B 36, 37 in Appendix B. So what are the meaning that these voting rights are not substantive? Voting right must provide investor the current ability to direct the relevant activities. That is about having power, current ability to direct the relevant activities in the investee, right? And that is normally determined by looking at the operating and financing policy of the investee. If you have no power, for example, let's say in another entity, let's say in government controlled company, government is the one that has the power, so-called biggest say to direct the relevant activities. And if that is the case, investor may not have the power over the investee, because maybe the government control company, whatever decision made by the government will overrule sometimes the right of the investor. Involvement of government, court, or administrator in an investee decision making, right, does not necessarily mean that owner does not have control. However, the careful consideration of all facts and circumstances may need to be made together with a professional judgment that is also required. And this one is another element under ability, which is where you have power without a majority of voting right, and that is called de facto control. Yeah, an investee can control and has power over the investee, even though the investor hold less than the majority of the voting right in the investee, if this one normally arises when an investor holds a significantly large minority of voting right as compared to the remaining shareholder, and it has also the current ability to direct the operating and financing policy of the investee. So it has maybe just 40%, which is a large minority, but there is a contractual arrangement between the investor and the other investors in the investee company that give the vote rights that investor has to make in terms of decision. Or maybe rights arising from other contractual arrangement to direct the relevant activities. This one is contractual arrangement between investor and other investor. This is the rights arising from other contractual arrangement other than A to direct relevant activities of investee. There are some agreement, memorandum of understanding, for example. Through the investors' voting rights, yeah, maybe you have that. Then that can you can refer detail paragraph B41, B45, or maybe you have you have large minority of voting right, but you do have potential voting right as an investor, or maybe a combination of A up till D, maybe AB, maybe BC, ABC, CD, for example. So this is the illustration trying to show you. I'm taking it from example 4 in the MFRS 10 itself, which is MFRS 10, paragraph B38. There are illustration there. Application example. Here you have investor acquiring 48% of the voting rights of an investee. The remaining voting rights are held by thousands of shareholders. None individually hold more than 1%. So you hold 48%. Other shareholders just hold less than 1% of the voting shares. None of the shareholders has the arrangement to consult any of them. Yeah. So they hold, none hold more than 1%. They cannot consult others to make decision. No arrangement. When assessing the proportion of the voting rights to acquire, on the basis of relative size. Remember, I have mentioned earlier of the shareholding, other shareholding. Investor determined that 48% would be sufficient to give it a control. So in this case, even if it is 48%, investor is said to have a control and it meets the power criteria. Yeah. Why? Because on the basis of the absolute size of the holding relative to the size of the dispersion in other shareholder. This will not be covered in terms of accounting in the consolidated financial statement, but this is just some theoretical application. Potential voting rights. These are the rights to obtain voting rights of an investee, such as if you have a convertible instruments or options, including forward contract. So you have the potential to obtain additional voting rights if you exercise the offer to convert your debenture, for example, into shares, or convert your convertible preference shares into equity shares. So when you assess this, investor also needs to consider whether the potential voting rights held by the investor as well the potential voting right held by other investor. An investor may hold instruments in an investee if that is being exercised or converted can give them additional power or reduce the voting power of other shareholders to direct the relevant activities, because ability to direct the relevant activities will give you power. So that is what you call potential voting rights, rights that exist from the exercise of the convertible instruments or options. And that was, for example, in the case of financial instruments, share options, warrants, convertible bonds, convertible preference shares, where these are now going to be able to increase the power of the investor or decrease the power of the other investor. So potential voting rights are considered only if the rights are substantive. So when you consider potential voting rights, investors shall also consider the purpose and design of the instrument, the purpose and design of any other involvement of investor has with the investee. Look at also with other non-controlling shareholder. Assessment need to be made in terms of condition and terms of the instrument. Look at the terms and condition of the potential voting right instruments, financial instruments that you have. What are the expectations? You need to also look at what are the expectations, what are the motives to exercise this potential voting right, what are the reasons to agree to those terms and conditions. And that is most important as well, to consider that the rights are substantive. You can refer paragraph B48 in the appendix B. You can check this as well in appendix B. I took this from MFRS 10 paragraph B40 appendix. This is example 10 that illustrate the potential voting rights. You can work through this example yourself, yeah, and also the example in the textbook at your own time. And what you can conclude for this first element of control, which is power, is that potential voting rights in terms of our case here give the investors current voting rights, some potential voting rights that if it meets the criteria that will contribute to control, right? So investor will need to assess that. So you can look at the exercise price of the instruments that you need to exercise, timing, the intention, the financial ability, whether the investor's practical ability to exercise the rights are there, financially viable, operational barriers or incentive, right? You can check that. We will continue with this presentation in my next video. I thank you for watching. I will continue with relevant activities in the next video with that. Thank you for your attention. I'll see you when I will see you.